Hello friends, welcome to Kavita's classroom. After talking about the producer's behavior and the forms of market, today we have to talk about the market equilibrium, means the last segment of the microeconomics theory. And this gives me the opportunity to talk about why do we call microeconomics as the price theory. Why is it so? Because price in the following pages I'll be telling you is determined by the forces of demand and supply, right? When we talked about consumers equilibrium, we got demand as a result. When we studied the behavior of a producer, we got to have the supply. After getting these two diagrams, right, these two curves and their interaction now will be giving us the market equilibrium and price and quantity to be traded in the market. So this is the result or the whole output of this study. That's why we call microeconomics as the price theory as well, because this is the end effect of the market microeconomics. So let's proceed. When we talk about concept of equilibrium is a situation where the market demand is equal to market supply, right? Any deviation from this means there is some sort of instability, and that instability would be automatically removed by the forces of demand and supply. So let's check how do we have the equilibrium situation determined in the market. So it has to have the two components, market demand. Market demand means the sum total of the demand for a commodity by all the buyers in the market, right? And when you talk about market supply, again, the sum total of the supply of a commodity by all the firms in the market, right? Equilibrium is stuck where demand is equal to supply. So let's understand the same with the help of a schedule and curve. As we know that if prices are falling down, the demand would have the tendency of rising. So the quantity demanded shows 10, 20, 30, 40, 50 as the upwards trend, right? And when we talk about supply, right, with the fall in the prices, the supply would be falling. So with this schedule, we got to know that the equilibrium is attained where demand is equal to supply, and here in this it's attained at the price 3 and the quantity 30. So if we want to make a diagram with respect to this very schedule, we would have this type of diagram where demand moves down and supply has got a positive slope, right? Their intersection will determine E. E is the equilibrium point, the point of intersection, right? And if you can notice that if E has to be given a clear indication of the price and quantity with respect to the above schedule. So we have 3 as the price with respect to E, see this, and 30 as the quantity. So if we are labeling only these two pieces on the scale would also work. So this is a situation of market equilibrium where demand is equal to supply, right? It is determined at price 3 and quantity 30. Now the question comes, what if the price shows some fluctuations? What does it mean? If there is any upward movement or hike in the prices, what would it result into? At higher prices, we all know the suppliers are ready to supply more because they would have more profits. But at higher prices, the consumers demand less, right? So here it would have a situation of surplus or excess supply. The demand would be less and the supply would be higher. And if the price falls, what would this result into? With the fall in the price, the demand would be higher and the supply would be lower, creating a gap, and this gap is called shortage. And this is also referred to as excess demand. But these are temporary situations in the market. Why I'm saying so? Because these would result into the equilibrium restored by the auto forces of demand and supply. Let's proceed how and why. Like when you're talking about excess supply, so how do we show the excess supply situation? This is the basic structure, and we would have this created many times. The basic structure of price, quantity, demand, and then supply Equilibrium is here, right? O, y-axis, x-axis. Here you show the quantity and here you show the prices. So where would you show the excess supply? Excess supply would be at a higher price, right? So if the prices move at P dash, the supply is more than the demand. So we clearly see that there is excess supply because at higher prices, the suppliers are willing to supply more. So what would be the chain reaction that it will restore the equilibrium price? See, at this situation, when the price is higher, situation of excess supply is created. Now think about this. If the supply is excess, there would be a competition, right? Amongst whom? Amongst sellers. So I'm just trying to jot down all the points in short form for your understanding, because this is a full-fledged question which is asked for 3 to 4 marks, right? That write all the steps or the chain reaction, right, to restore the equilibrium from the situation of excess supply. So the very first thing is, when the price rises, with rise in the price, we have a situation of excess supply. Okay. First, we have to recognize the situation. If the supply is excess, what would happen? It would lead to the competition amongst sellers, because everybody would try to sell off its product, right? Because there is more supply than the demand required in the market, right? So amongst sellers, we would have the competition, and this will result into the fall in price. Say the price falls to this level. Okay. So it means the price has gone down. So the law of demand and law of supply will come into picture, right? So with the fall in the price, as per the law of demand, what would happen? The demand would rise, right? It would lead to expansion. So see, from here, this point, earlier the demand was here. Now, because of the fall in the price, the demand has risen from this level to this level, right? And because of this price fall, the law of supply also comes into picture, right? And because of that, the supply reduces. That is, supply contracts. See, gradually, slowly it starts falling down. So when the supply was here once, because of the price rise, now it has reduced at this point. So there is a fall in the supply, or we will say contraction of the supply. Right. So what has this resulted into? This has resulted into the, yes, excess supply is still there, but is now reduced. So this process of fall in the price and the expansion of demand and contraction of supply keeps on moving, repeating, right? So we'll say this keeps on repeating. Repetition happens of this phenomena, and then what would we have? This would come down, then we would have this less but still some excess supply there, right? Ultimately, at last, when the price falls to this level, which is the equilibrium price, here we have the demand equal to supply. So here the stable equilibrium would be restored. So after repeating this process as many times as is required till there is excess supply, right? There is equilibrium and the stable equilibrium restored. And how has it restored? With the help of demand and supply forces only, with the movement in the or the fall and rise in the prices. Right. On a very similar note, let's talk about the excess demand case now. So when we talk about excess demand, let us plot the same. So this is demand curve, this is supply curve, and where is excess demand? When the price is below this equilibrium price, when for some reasons the prevailing price is less than the equilibrium price in the market, what does it result into? This situation where we have a gap in demand and supply, and we call it excess demand. Now, if we want to write down all the steps which are required, right, for evaluation purpose, first you recognize what is the situation. This is a situation of excess demand. Now, what would it result into? Because of excess demand, there would be a competition. Amongst whom? Amongst buyers, right? And because everyone wants to have the product, right? So they are willing to have the product even at a higher price. So this will push the prices up in the market. Say the prices pushed here in the market. So it means with pushing up of the price as per the law of demand, the demand contracts, and as per the law of supply, right? So law of supply would say with the rise in price, the supply would expand. So this expansion and contraction would be shown by these small arrow signs that supply is expanding. It's showcased moving upwards and demand is contracting towards left, right? So this process keeps on repeating. This is repeated till the excess demand vanishes from the scenario and there is such a situation where demand is equal to supply and hence a stable equilibrium is restored. So this is how we say that equilibrium prevails where demand is equal to supply, right? And at equilibrium price, the market is stable. But if there is any deviation in the market due to the high and low prices, these would be auto restored by the market forces of demand and supply. Right? With this, we close this session here and we'll next talk about what happens when there is a shift in demand or supply or both. Till then, keep studying hard. Bye-bye.